All right, what's up, everyone? So it is Karthik with Money Vest. Thank you so much for joining. Here we have Trump arriving in Abu Dhabi in the United Arab Emirates on part of his trip to the Gulf. So Saudi Arabia was first day. Then, of course, Qatar was yesterday. Today is going to be UAE. So there you have Sheikh Mohammed bin Zayed Al Nahyan meeting with Donald Trump as he is coming off of Air Force One. Jay Powell is also scheduled to speak in about 20 minutes. So this is going to start at 8:40 a.m. Eastern. So I will be live, of course, to cover the remarks from Chairman Jerome Powell as well. This is a research conference. They are going to be discussing about the monetary policy, interest rates, inflation expectations, economic conditions, all that stuff. Usually is about a 40 to 45 minute discussion or conference. And then, of course, we'll take a look at the markets as well. Inflation numbers are also going to be coming out in about 10 minutes. We've got the PPI numbers also scheduled to be released. So do me a favor and share this live stream with other people, friends, family, traders, investors, so we can have more and more people join us for this live stream as we are covering both Donald Trump and his movement and here where he is. And of course, Jay Powell, that's going to be coming up in about 20 minutes now. So at 8:40 a.m. Is when the speech will actually begin from Jerome Powell. So lots going on, lots to discuss, as I'm sure you guys are excited. Markets have been going crazy over the last 3 to 4 weeks here as we are seeing very, very strong growth in individual stocks. I mean, Tesla, Nvidia were the big winners from yesterday, pushing up over 4% each. And a lot of great deals being signed. Saudi Aramco, 34 MOUs, Memorandum of Understandings, between ExxonMobil, we got Amazon Web Services, Qualcomm, Nvidia, Advanced Micro Devices, Palantir, a lot of deals between Saudi Arabia, Qatar also buying over 200 Boeing Dreamliners as well as these big aircrafts for Qatar Airways. So I saw a lot of those videos over the last couple of days here, and I'm sure UAE is also going to be investing a lot in to the US as well. Lots of deals coming in from the UAE as well. So let's head over to BLS.gov. Again, inflation numbers. PPI is going to be coming out in just about 8 minutes or so. So this is going to be the next producer price index numbers that are scheduled for today, May 15th, 2025 at 8:30 a.m. Eastern. So we're going to take a look at that. And I think there was some conversation while he was on air as well, Donald Trump. I think he did like a really, really short live stream from the air. So, but I think it was audio only, so there wasn't really a lot of discussions. It was a very, very short live stream. But I'm sure we're going to hear a lot between the UAE and, of course, the relations with the United States, and of course Jerome Powell coming out in about 20 minutes or so. So is Jensen Huang in the UAE too? So I'm not sure. I mean, they were all there in Saudi Arabia. So of course we got Alex Karp, Jensen Huang, Lisa Su, Elon Musk, Larry Fink, lots of people meeting, Sam Altman meeting with the Saudi Crown Prince, Mohammed bin Salman. So there was a lot of meetings there. I mean, that entire hall was filled with business leaders and corporate CEOs of some of the biggest companies in the world. I mean, Saudi Aramco was also part of those negotiations, as they are investing heavily in U.S. companies, in U.S. infrastructure, and vice versa. So, I mean, as I said in my previous updates, the Gulf doesn't play around. There's big money here, petrochemicals, natural gas, oil, and so they're investing a ton of money, and of course vice versa. I mean, that's where a lot of these deals are being made, right? So there's literally deals being signed during this entire visit to the Gulf. So yeah, I mean, that's been one of the reasons why we're seeing the markets kind of be a little bit more optimistic, as there is a lot of foreign investment coming in. And for those reasons, we're seeing, the likes of Nvidia and Tesla. I actually posted this on our Instagram as well. My Instagram, I posted that it's really not that complicated if you simply follow the momentum and the movement of these leaders and where they're going, who they're meeting with. You can kind of figure out, okay, where's money going to? Like, where's big money being invested at the moment? So, Jared, Kenny, do you live in Dubai? Yes. So I live in Dubai. Donald Trump is literally in my neighborhood in Abu Dhabi, so about an hour and a half away from where I'm at the moment. And I don't know if he's going to be coming to Dubai or not. I think he will. But I don't know. We'll see. We'll keep you guys updated, of course, with what's happening with those negotiations, and of course all the updates, all the deals that are being signed between the U.S. and of course the rest of the world. So hope you all are doing great. We got almost 500 people watching. Jerome Powell is going to be coming out in about 20 minutes or so, under 20 minutes. So we're going to be listening in to him. It's going to be a 40 to 45 minute conference. And then, of course, we'll keep this live stream going as well as UAE welcomes Donald Trump on his three-country visit in the Gulf. So, of course, we started with Saudi Arabia. Then we moved over to Qatar yesterday. And then today is going to be the UAE. Tesla deal with UAE too. I mean, there's a lot of Teslas here. I mean, believe me, I see a lot of Teslas here in Dubai. I mean, there's a lot of people, big market. The only problem, of course, is the population size is not as big as the likes of US or India or China. But the market is still pretty big, and it can be penetrated, very, very strongly. But also the thing is that oil prices here are really low. I mean, you're paying really low for gas prices. So, the whole electric vehicles are more cost efficient sort of case does not apply to a lot in the Gulf countries because oil prices are incredibly cheap. It would take almost identical amount of money, same amount of money to fill up your car with gas than it would to charge your electric vehicle. And so that is one of the things that, of course, is not very favorable if you're switching over to EVs for saving money. So yeah, I mean, we'll see what kind of deals happen with the UAE as well, and how much is gas there. Let me double check, but I've just recently started driving once again because I don't really go anywhere much, but I've started joining this workout, like a group workout. So I go there every 4 or 5 days in a week. So I've been driving now more often. But let me check for you. Yeah, so it is around 2 dirhams and 58 cents per liter. So let me just do that very quickly. 258 divided by 3.67. So yeah, we're talking 70 cents per liter. And let me just do liter to gallons. So 1 liter is 0.26 gallon. Okay. 378. Yeah, so it's around 250 per gallon, roughly. Or, yeah, if I'm not mistaken, it'll be roughly around that number. So yeah, I mean, relatively, yes, it is cheaper. Yeah, Megalift 70 cents per liter. Yeah, that's roughly correct. 70 cents per liter. In Portugal, it's around 1.2 to 1.3 euros per liter. Yeah. So again, gas here significantly cheaper. Anyway, so we got PPI numbers coming out in 3 minutes, everyone. So 3 minutes until the producer price index inflation numbers come out. And of course, here we go. Donald Trump walking alongside Mohammed bin Zayed Al Nahyan. So the Sheikh of Abu Dhabi and the president of the UAE as well. And then, of course, Jerome Powell is going to be speaking in about 20 minutes or so. So there you have it. About a couple more minutes until PPI numbers. Bruno says, yeah, 1.7 euros per liter here. Yeah, I got a job offer there, but don't want to leave Germany. I mean, Dave, you should try it. See what it's like, and then you can always make a decision to go back. But I'm always here. So if you're ever here in Dubai, if anybody's here in Dubai, I'm always here to meet up and, of course, make you feel home. So, Dave, is everyone rich in Abu Dhabi? I mean, Abu Dhabi's got a lot of oil, right? Oil and gas, similar to Saudi Arabia, similar to Qatar. Qatar has more natural gas. Saudi Arabia has a lot of oil. And Abu Dhabi has a lot of oil as well. So, when are you coming to London? So, soon. Soon. I will see if I can squeeze in a trip this year. I've been planning to go to Australia, Sydney, for a long time. So, we'll plan Sydney first, and then we'll see if I want to come back to London. But to be honest, like, there's not been a lot of reasons to go to London this year because Manchester United has been doing really poorly, and we're almost on the verge of relegation, so I didn't really feel the need to go watch them lose. So I didn't really plan a trip for this year. But I was there last year. I visited and, of course, saw a few games over there as well. So, yeah, we're going to talk a little bit about UNH as well, United Health. We'll talk about that. That's been on the news. There's been a lot of discussion around UNH. But let's just quickly take a look at the producer price index numbers if they're updated. So that is going to be for the month of April. Here we go. The producer price index fell 0.5% in April, seasonally adjusted, and we got the April decline in the index for year-over-year numbers. We're now sitting at 2.9%. So for the 12 months ending in April 2025, the index for final demand, less food and energy, so core PPI now sitting at 2.9% here. So that is where PPI numbers are. Price of final demand services moved down 0.7% in April, the largest decline since the index began in December 2009. And this is the 12-month numbers that we're seeing. So final demand numbers, we're sitting roughly around 2.4. And then, of course, core is going to be sitting at 2.9. So we are coming down from these previous numbers here. Prices for final demand less food and energy on a month-over-month basis edged lower by 0.1%, so deflation on a month-over-month basis, and the first decline since falling 0.8% in April of 2020. So markets not really reacting all that much because CPI is a much bigger, more important catalyst than PPI, but nonetheless, these are still pretty strong numbers from an inflation standpoint. So let's just quickly come here and take a look at Jobless claims numbers also coming out. So PPI right about there. So 229,000 jobless claims. So again, still pretty low. This is not a crazy number. This is nothing to worry about. It's not until after we get up to over 400,000 or more is when I will start to become a lot more concerned with the state of the labor market. PPI, 0.5% decline on a month-over-month basis for headline producer price index numbers, and I'll wait for them to get updated, but core PPI is sitting at 2.9% at the moment as well. So there you have it. So inflation numbers coming in strong. Inflation numbers coming in good. So there we go. We got the markets slightly higher. We got QQQs pushing up a little bit over pre-market, but still down about 30 to 39 basis points. Yeah, no sound on YouTube. There is no sound. I have the sound turned up, but there's nothing that I can hear. Also, there's no sound on this live stream. We can't hear them talk right now. So just if you're wondering what they're talking about, we can't hear them talk right now. There is no sound on this stream. So. And for the right reasons. I mean, we're not gonna know exactly what they're chatting about right now. For Tesla, we are down about 1%, and Nvidia is down about 30 basis points right now. So that's where we are with inflation numbers, like I said, coming in really, really strong. CPI was good this week. 3 out of 4 accounts, we beat expectations. It's moving down in the right direction. And of course, PPI also coming down quite a bit. So this is the entire report with core PPI sitting at 2.9%. And month over month coming down, edging down 0.1%. That's on a core basis. Headline inflation falling 0.4%. And for 12 months, it is now sitting at 2.4. So headline PPI year over year 2.4. Month over month down 0.5% versus expectations of 0.2% increase. And then on core basis, 0.3% was the expectation that we're going to move up by 0.3%. But instead, we actually saw a 0.1% decline. So deflation on both headline and core PPI. And then, of course, headline year over year, we're sitting at 2.4. And for core year over year, we're sitting at 2.9, which is also lower than where the consensus was at 3%. So also a very strong inflation print. Market's getting a little bit of a lift here, pre-market on this inflation report. So why do we call him Caddy? So that's kind of like my nickname, everyone. So if you are an older subscriber, you know what my nickname is. But then, of course, I go by my actual name now, which is Karthik. So feel free to use either or. But Powell better be dovish, Kevin says. Yeah, speaking of Jay Powell, everyone, for people who are joining in, Jay Powell starts talking in about 5 minutes. So 5 minutes, this live stream will begin. In fact, it's already started. So
to the paper authors, discussants, and panelists for investing their time and energy and sharing their insights with us. And let me thank all of you in attendance for contributing to what I'm sure will be a very engaging and productive conference. Before we turn it over to the chair, let me address just a few logistical items. For everyone's awareness, this conference is being live streamed on the board's website and YouTube channel, and the recording will be available for viewing later. Please keep this in mind when posing questions or making comments, and members of the press are here today as well. All of the conference materials, including the papers and the presentations, will be posted to the board's website. Each of our paper sessions will begin with a presentation by the author, followed by comments from a discussant, and then we'll open it up to the room for Q&A and discussion. Whenever making a comment or asking a question, please use a microphone so that people can hear you both in the room and, importantly, online. When you speak, please begin by introducing yourself, and please try to keep your remarks concise so we can create more opportunities for other people to participate. If you have any questions about anything related to today's conference, please find any of my colleagues around the room or outside who are wearing a white lanyard. They'd be happy to help you. With that, let me get us started by introducing Federal Reserve Chair Jay Powell, who will offer opening remarks. Thank you.
Thank you, Trevor, and good morning. I'd like to add my welcome to everyone. Thanks for being here. Thomas Laubach's research and his broader support of the FOMC helped us better understand monetary policy, and it is fitting that this work will continue today in his name. Thank you to the authors of the papers, to the discussants, and to our panel participants, and thank you also to Trevor and his team for organizing this conference. A whole lot of work went into bringing us together. As in our last review, the 2025 review consists of three key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled The Statement on Longer Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies, inflation regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Thank you very much. We are going to just roll right into our first paper session today. On the agenda today will be sessions that address the two sides of the Federal Reserve's dual mandate, employment and inflation, and also the strategies and tools used to pursue those goals. So I'm going to turn it over to my colleague, Stephanie Aronson, who will moderate this panel.
All right, just give us a second here while we get set up. Great to see everyone here this morning. I'm super excited to be kicking off the session. I'm Stephanie Aronson. I'm a Senior Associate Director in the Division of Research and Statistics. And I was told that I could say a few words about why our first session is important. But the title of the first session, I think, pretty much speaks for itself. The labor market and maximum employment. It gets right to the heart of the Fed's dual mandate. So enough said about that. I think I'm also just going to take a very quick moment to introduce our two panelists. So our presenter is Aisha Shahin. She's a professor of economics and public affairs at Princeton University. And since we're here at this system conference, I'm also going to note that for many years she was our esteemed colleague at the New York Fed as a research economist there. Her work focuses on macro labor issues, including measuring maximum employment and unemployment and labor force participation dynamics, which makes her a great person to get the session started. Our discussant, thank you, is Eric Hurst, although I suspect everyone could hear me, right? Never a problem. Our discussant is Eric Hurst. Eric is the Roman Family Distinguished Service Professor of Economics at the University of Chicago's Booth School of Business, and his work lies at the intersection of macroeconomics, labor economics, and urban economics. He's worked on issues near and dear to my heart, like the decline in male labor force participation and welfare losses stemming from gender and racial discrimination. So I think with that said, Aisha is going to get us started. And you'll have 30 minutes. Finish at 8:20.
Thank you for the invitation.
All right, everyone. So I'm going to put that in the background until we hear from Jay Powell again. I'll bring it back over. Usually this is a panel discussion where there is a lot of Q&A. and focus on monetary policy. Like I said, the dual mandate, which is inflation as well as employment, making sure that both are functioning well in a good functioning economy. But we'll, again, replay this if Jerome Powell has anything useful and important to talk. But right now, not so much. Markets are essentially flat right now. We got QQQs down about 0.5%. We got SPY down about 41 basis points. Inflation numbers just came out earlier today. PPI numbers came in very, very strong. So if I bring over the numbers once again, this right here was the report. Negative 0.5%. So we actually saw deflation in the U.S. economy for the month of April, 0.5% for PPI on a month-over-month basis. And headline, staying put at 2.4 on a year-over-year basis, but the biggest gains coming in from core PPI, excluding for food and energy. That was a 70 basis point swing on the downside. 0.3% was the expectation. We came in at negative 0.4%, so significant deflation for core PPI month over month. And year over year, we're sitting at around 2.9 and 3.1% if you don't exclude for services. So core PPI excluding for food and energy sitting at 3.1. And then, of course, excluding for services, we came in at 2.9%. That was also better than the previous number here. So this was the actual report. So excluding for food, energy, and trade services, we were looking at 2.9% on a year-over-year basis. Donald Trump is also in Abu Dhabi. So I mentioned that earlier as well. And we'll continue to monitor the situation and what kind of deals are being inked between the UAE and, of course, United States as well. This is the latest that was just released after Jerome Powell's speech here. Fed's Powell cautions about higher long-term rates as supply shocks provide policy changes or challenges. And so Fed Chair Powell said Thursday the longer-term interest rates are likely to be higher as the economy changes and policy is in flux. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for the central banks as well. So that's where we are.
To sell up to 500,000 of the most advanced US chips into the UAE. That would, of course, not just be a catalyst for NVIDIA, but also a significant development for the Emirates, which is, of course, trying to build out its AI capabilities. At the same time, we're also watching for any potential news on what could also be an announcement from OpenAI as well. So watch this space. And, of course, all of this coming as we also saw the president making waves in Saudi Arabia, signing that $600 billion US commitment on investments, and of course stops in Qatar that included a $1.2 trillion agreement, according to the White House. And now the focus also shifting over to the UAE, where that investment run, at least according to our sources, is likely to continue.
Dan, in Abu Dhabi this morning, want to thank you for your reporting. It's been fascinating to watch the president as he's been making his way through the Middle East. Kelly?
Andrew, thanks. Coming up, shares of Walmart retreating from their early...
So there you have it. That's all of it today, you guys. I'm going to be heading off. Just got to spend some time in our Discord. Got to send out some alerts, some updates for what the plan is for today and, of course, for tomorrow to wrap up the entire week. We'll keep you guys updated on whatever the developments are, what kind of deals we're getting out of the UAE. And, of course, if Jerome Powell starts talking again, we'll share the live stream and the updates in our Discord as well. So hope you all have a fantastic Thursday. Make sure that you drop a like and subscribe. And again, if you want to be a part of our Discord, I'm not going to be doing live streams during market opens because it becomes very difficult for me to trade and look at the markets and make my own decisions while also live streaming at the same time. But I will be live pre-market and, of course, go over the entire plan and, of course, support resistance levels, some trade ideas in our Discord as well. So link's going to be down below if you want to be a part of our family. We're more than happy to help you in your trading and investing journey, whether it's long-term investing, swing trading, options trading, whatever it is. So have a great Thursday, and we'll see you all in the next live stream. Happy investing.